Market probabilities for a March rate cut coming down a bit, now sitting at 57%. Our next guest agrees with that sentiment, saying a cut that soon would be too aggressive. He sees some choppiness ahead for the markets and several areas of opportunities to strike on amid the pullbacks. For more, let's bring in Matt Orton, Chief Market Strategist at Raymond James Investment Management. Matt, welcome. Good to have you with us.
Great to be here, Tyler.
You don't argue with the fundamental thesis that the Fed is likelier to loosen rates this year than not, right? But you just are questioning whether the timing in March is too soon.
Yeah, that's absolutely right. You know, it's clear that the Fed has hit the peak, that we're going to be cutting rates this year. The problem is the market got really, really aggressive, Tyler, in pricing in rate cuts, pricing in 6 rate cuts at the start of the year and putting up to an 80% probability that we were going to get a cut in March. But at the same time, you have an economic backdrop that's pretty darn positive. You have strong jobs growth. I think the trajectory to get to consistent 2% inflation target is not as easy as everyone thought. So, you know, I've been telling a lot of our clients that we've got to go through some normalization first. We're seeing that play out a little bit this week. I think there's still more room to go. But at the end of the day, the fundamental backdrop supporting earnings growth and supporting a broadening of the market is still very much in place. So what I say is use downside opportunistically to diversify and set your portfolios. And if you've got cash sitting on the sidelines, rates are going to come down. So have a plan and start to execute that plan, because there's plenty of interesting areas in the market.
I guess one of the things that I may be full of it here, Matt, and you can instruct me if I am, and I admit I'm full of it more often than not, is the idea that there's money on the sidelines. There's all this money, this tonnage sitting there in money market funds. And indeed, money did go into money market funds over the last year as rates rose and the returns on those funds became more palatable, more enticing. But I'm always suspicious of the idea that money is going to leave those money market funds and fuel a big rise in equities. Tell me I'm wrong to be skeptical.
No, Tyler, I think you're right to be skeptical, because you don't always see money leave those short-term instruments.
Yeah.
But what I would say is you have to think about why $1.2 trillion went into money market funds last year when the market was up, 26% or so. And it started off as being defense. It started off as being, I'm uncertain about where the market's going to go next year. And then another big part of that was rates are continuing to increase, and I can get paid 5.25%
I can get 5 or 4 or 5% to keep my money in a safe place. And that doesn't sound too bad to me after an era when I was getting 0% to keep my money in these places.
Yeah, 100%. But then look at what has changed now. So those who went into those money market funds who were overweight, they missed out on the capital appreciation component that you can get both with respect to fixed income and equities. And a lot of them said, okay, at 5%, it might go a little bit higher. I'm going to wait. And now we went down to 4%. And so I think there's more of a very visible opportunity cost to sitting there. And I think at the same time, as the investors who are sitting there, who are there for more of the I need income part of the equation, they can get that in stocks, they can get that in bonds now. And as rates are coming down, I believe you're going to see that money start to move, especially when the economic picture is still pretty benign and solid.